it's a difficult one, isn't it? You've got a business here where your main shareholder base are all the big financial institutions who are buying into this stock because of its dividend. That's what it's well loved for. It's a core component of any income portfolio.
Right.
And so you have that pressure all the time. So, I suspect if it turned around and said, sorry, we've got to cut the dividend probably for 5 years because look at what we've got coming. But they've got to put a fair argument. If they do cut the dividend, how is the shareholder base in the longer term going to be better off? The same's happened with the water companies. The water companies have been paying out far in excess of what they can. And where are we now? They're underinvested. We've got big problems. And one of them's effectively gone bust.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello, Chris. Good to see you again.
Hi, Lee. Good to be here. Interesting week.
Absolutely. And we thought we'd get back to the standard weekly news and some updates on some interesting stocks for you to take a closer look at. We're going to start off with the ECB rates. We've got UK construction, National Grid. Chris has got an interesting, shall we say, rant about that one, Chris, shall we?
Yeah, I think I must hold back on the rant a bit on that. Yeah.
Is Tesla now undervalued? We've got WHSmith, we've got Ramsdens, we've got Fever Tree, we've got a bonkers bargain for you to take a closer look at, and of course, much more as we go through. So yeah, Chris, ECB.
ECB's cut its rates to 3.75%. So it's ahead of both the Bank of England and the US Federal Reserve. It could be a sign. Is it the sign of more rate cuts, or is that it? So I think people are thinking now that's it from the ECB. So we wait to see what the UK is going to do. I have a feeling if the UK will generally follows the US, so they're never very brave. But the ECB seem braver than us and the US for once. Good news on the ECB.
Yeah, leading the charge for a change.
Yeah, the problem out there is in the Eurozone, inflation went the wrong way, so they might hold fire with more rate cuts. But yeah, it's a start anyway, positive start.
Yeah, and closer to home, UK construction expands fastest in 2 years. That's good news, isn't it, as well?
It is very good news. I bang on about this every week, how important the construction sector is in the UK. It encompasses so many trades and so much money, really. So it's such an important sort of barometer of how well our country's performing. So UK construction activity rose more than expected in May. Fastest pace for 2 years, led by house building. Really. So that's good news. And we've highlighted numerous occasions the appeal of companies in the construction materials sector. They're trading at really cheap valuations. Several of our bonkers bargains candidates are really cheap stocks, which we theme as bonkers bargains. They're in the construction materials sector. One of them is Alumask, which we've been projecting the merits of for a while. Another one is Micklemersh Brick Holdings. Two really nice small companies. So yeah, I would implore you to investors to look at the construction materials sector because there could be some great recovery plays in there if this momentum keeps up, definitely.
Yeah, that's absolutely brilliant news. And as always, and as we say this most episodes, feel free to visit Investors Champion to learn more about all the bonkers bargains and the many, many reports that Chris and the team writes on these companies.
Some of our bonkers bargains are really flying. They're doing very nicely indeed. And they've got loads to go still because they're still really cheap, a lot of them.
And we're going to touch on Gemfields as well later on, aren't we, as well, which is another bonkers bargain.
That looks great. That looks really cheap. That's already started to perform for us. But yeah, a lot of value in the UK stock market. That's why everybody's taking over our companies.
Yeah, true. One company that they're not taking over, though, is National Grid.
Yeah, this one is totally bonkers for other reasons. I just can't get my head around this at all. So National Grid was a constituent of our income boosters portfolio because it has the attraction of a big dividend. Now, anybody listening to this has a pension, its pension will probably be holding National Grid because it's a huge dividend payer. It's a £42 billion company. It's been paying out circa £2 billion of dividends each year. So pensions love it because it's a consistent and regular dividend payer. But what National Grid needs loads more money. There are going to be growing demands on the electricity network. So it owns the transmission network in the UK. It's not a producer of energy. It's a transporter of it. And it's refocused really in electricity. clearly we're all going to be plugging in our electric vehicles, and there's going to be more and more electricity consumed compared to gas. So the whole network needs loads of money. According to National Grid, about 60 billion. So to help it with this task, it's gone to shareholders and say, right, we need another 7 billion from you. We're going to doing a rights issue at a big discount to the share price at the time, and we want 7 billion from you. But by the way, at the same time, though, we're getting new money of 7 billion. We're increasing the dividend. This is just insane. What businessman in his right mind suddenly raises more money at vast expense, paying investment bankers huge fees, and immediately sends a load of it back to shareholders? It's totally inefficient. The numpties running this business need their head examined, surely. No normal businessman would be able to manage their finances like this. So National Grid is clearly living beyond its means. It's having a really tough time balancing its capital expenditure demands with what its shareholders' demands are, notably its pension fund shareholders, who are demanding this dividend all the time. I just think it's ludicrous. The CEO of this business, if he owned 100% of it, would he be doing this? Would he be going down this line? And saying, I want to hold my dividend, but I'm gonna raise money, but then pay myself a bidding and incur huge costs at the same time. I don't think he'd be doing that. So clearly, I don't know. It's just, in terms of capital allocation, it's the most ridiculous thing I've ever seen. We've seen a few.
So, question then. It was in the income boosters. Will it remain in Investors Champion income boosters?
It's out.
It's out already.
It's performed okay for us over the time it's been in our income boosters portfolio, which is our higher income yielding portfolio. But yeah, this just looks crazy to me. And it's a classic case of sort of the dividend demands exceeding the capital expenditure issue looming. The capital expenditure this business needs to spend is just vast. It's probably going to be well under budget as well. Typically, all these things always are under budget. Yeah. So where are we going to end up? I think it's looks a complete train crash. It's barely now existing as a publicly listed company. I just see how it works.
Do you think we'll probably see the nationalisation in the near future of this in order for the government to meet its net zero 2030 demands? Because clearly from what you've just described there, National Grid are not going to get the electricity network up and running in time.
Miles behind the curve on this. I reckon they've been kicking this can and they down the road, but they've still been spending an awful lot of money. Debt in this business is ballooned over the last 5 years. So they've still been spending a lot, but clearly nowhere near enough. And we're well short of when the time comes that 20% of the population's got electric cars and electric everything else. If everything's going to be electrified, heat pumps as well to our homes and the water and things, that's going to add another massive load onto the system. And that's before we even switch on the kettle. Yeah, I just think it is a quasi-state business, this, because all the demands, the pull, is coming from the state, isn't it? It's demanding that net zero by a certain date. And sorry, you guys have got to fall in line or else. So it's a quasi-state company.
I suspect the government will allow it to continue as long as it can, raising shareholder money, letting the shareholders fund the new electrification of the network until it becomes untenable, because it probably will happen, won't it? They're not going to meet the demands, the necessary demands.
Well, not that, but the government doesn't want to get involved. This is one of the first privatisations. It doesn't. It's going to stick around. It's going to be hanging around in a sort of quasi-zombie kind of thing. It's and keep hopefully chugging out its dividends that everybody's going to be happy with. And in 10 years' time, they'll look at the share price. It's probably going to be, 20% down on where it was. But everybody would have had their dividends still.
That's it.
And pay tax on them. I'm sure other more knowledgeable investors will give another argument, but I'm a simple kind of investor, and the situation of taking a lump of money from shareholders on one hand and then almost immediately shoving it back to them with the other looks just crazy to me in terms of capital discipline.
Oh, it's interesting to me. You said that they've got a lot of debt as well. So they've been paying out a very high dividend, but equally loading up the debt as well in the background. Surely lower the debt and you don't need as much debt. Surely that's just logical, isn't it?
They've been having to spend huge amounts of capital expenditure the last 5 years, but they're still committing to their big dividend. Nothing's given at all. They've been stretching things at every point to the extent that, to all intents and purposes, dividends have been paid out of debt. And debt, what's it become? Debt's become more expensive.
So I'm confused here. Who's demanding the dividends? Obviously, the pension companies, they like the high yield. But what's preventing National Grid turn around and say, hey, guys, we can't pay this much. We're not going to pay this much.
It's a difficult one, isn't it? You've got a business here where your main shareholder base are all the big financial institutions who are buying into this stock because of its dividend. That's what it's loved for. It's a core component of any income portfolio.
Right.
And so you have that pressure all the time. So, I suspect if it turned around and said, sorry, we've got to cut the dividend probably for 5 years because look at what we've got coming. But they've got to put a fair argument. If they do cut the dividend, how is the shareholder base in the longer term going to be better off? The same's happened with the water companies. The water companies have been paying out far in excess of what they can. And where are we now? They're underinvested. We've got big problems. And one of them's effectively gone bust. It's all the same. These are state organizations that are in the hands of either the private sector or the public markets, but they're still dependent on the state and the demands of the state, and they're becoming increasingly more demanding.
We can go on forever with that one.
I can rant a long time on that because I just found it totally perplexing.
You've put your money where your mouth is because you've taken out the income boosters portfolios. Yeah, that's obviously a stronger statement than anything. Yeah, so moving on to more international then, we've got S&P 500 and the NASDAQ. They've rose to new record highs, risen by that good old company that we've mentioned a few times, NVIDIA.
Yeah, NVIDIA, one of our ultimate stocks, a constituent of our ultimate stocks portfolio, and it's become the world's second largest company. It's gone over 3 trillion in value, so it's gone ahead of Apple briefly. It might have gone back again by the time this podcast goes out. But yeah, NVIDIA got over 3 trillion valuation, boosted by what they think could be a 10-for-1 stock split. I mean, that doesn't add any value. Its share price is about $1,200 at the moment, so it's going to be divided by 10. You're going to get about $120 a share, which conceivably is going to attract more retail investors into the stock. But yeah, I wouldn't blame people wanting to take profits out of this business, given the share price rise. This is staggering. I know it's putting out great numbers, but the shares are trading at 45 times forecast earnings. So it's quite rich. That assumes they're going to grow. The earnings are going to grow 100% next year. It's pretty encouraging. But yeah, one person who clearly wants to take some money off the table is actually NVIDIA's CEO, Jensen Huang, who is well known for wearing his leather jacket on investor relations calls. But he's taking a heap of money off the table. He's selling $735 million of NVIDIA stock. It's quite a lot. However, Jensen still owns just over about 3.5% of the business, which is still worth about 108 billion. So he's still got 93 odd billion left to worry about. 700 million. I wonder what he's going to do. What can you do with $700 million just like that? Bang.
Yeah, it's an interesting question. I suppose that when you get to that sort of level of money, I'm surmising, you start thinking about legacy, don't you? Your children, your grandchildren, making sure that there's enough for many years to come.
Legacy out of 705 million cash.
All right, great grandchildren.
You've still got an eye on whatever it is, just under 100 billion left.
Yeah. If you ever get there, Chris, just let me know what you're doing.
It'd be nice problem to have. But well done to him. He's driven the business hard, done a great job, and it's an amazing story. It's got to keep delivering now. The short term looks fine. You wonder in 5 years' time how things are going to be working out. And the authorities, the regulators, are now poring over AI and have their issues, and all the big AI players are under sort of the cosh a little bit, or under the microscope, shall we say.
I think they should be as well. We've got regulations in health, we've got regulations in banking, we've got regulations in mining and all sorts of the other major industries. AI is a major industry, will become one. There does need checks and balances, in my opinion.
Yeah, and positively, I think they're addressing them quite quickly. They're not letting this get out of hand because it's still in its infancy. This is still early days, isn't it? But the scrutiny is being increased now.
Yeah,
5 years' time.
Unfortunately, regulations are usually reactive. And I do think they need to get ahead of this just in case, worst case scenario.
Yeah.
So moving on, could Tesla? Do you think Tesla's looking undervalued now? The old Elon Musk there?
Our tech gurus highlighted the appeal of Tesla. Its share used to be it still is notionally a member of the Magnificent Seven stocks that have been driving the stock market, but Tesla has been actually doing the opposite. Its shares are down 40% over the last 12 months. Its market capitalization, its value is now only 567 billion. That sounds quite a lot, but this was up at the trillion level at one point. But that's still, to put it into perspective, that value is more than 10 times that of Volkswagen. You get 75% of Porsche as well with Volkswagen. So look, Tesla's still got a high valuation, but our tech guru wanted to focus on its position in autonomous cars, which is pretty well known. It's well known that's a growth area, and the Chinese seem to be keen to move there as well now. but it's Optimus robots. Apparently, it's got this position in robotics as well, which is also quite exciting. So it's Tesla, really to emphasize, is more than just an electric car company. If it was just that, it wouldn't carry this valuation. It's the other aspects. It's autonomous driving and it's robotics, which look, and it's, people should remember, it's cars are picking up data all the time. They're collecting data and processing it, which is going to help develop these two other strands. It's an incredibly exciting business run by a very demanding, exciting sort of leader in Elon Musk. Not one to ignore, definitely. But is it undervalued? I can't get my head really around the valuation. It's a tough one still, because I still look at it as a car company at heart.
Yeah, that's the interesting point, isn't it? How you look at the company. Is it a car company? Is it a technology company? And I guess wherever your filter falls on that will decide whether you think it's undervalued or overvalued, won't it?
Yeah, and if it's all about AI and machine learning, these robots, can they learn from their mistakes? Its ability to learn, this is pretty nifty stuff. And by extension, the use of robotics across all walks and manufacturing and walks of life in the future could be huge. And this is at the forefront of it. It's going to be its next leg. First, we had electric vehicles, then autonomous, and then robotics. It's very exciting, for sure.
Yeah, I'm a fan of Elon Musk, and I think all the more power to him. But we'll see how it gets on. See if Tesla gets back to where it once was.
It'll be interesting.
Yeah. Moving closer to home, though, a couple of fund managers here that have caught your eye.
Yeah, they've been announcing lately. We always talk about the stock market. The primary beneficiaries of a rising stock market are fund management groups. And clearly, they've also been hit because of falling stock markets. And unfortunately, it's been a difficult space because everybody's investing in passive index tracking funds. And these active fund managers, active stock pickers like we are, all right, we focus largely on smaller companies. But the people focusing on bigger companies and the stock market as a whole have really been struggling, and their shares look pretty good value. And you've got a few of them on AIM. They've announced this week we had Premier Miton, which has been one of the laggards. It's really a generalist, lacks specialization, but you get even a bit percent dividend on that one. Premier Miton Group. Another one which is more specialist called Impax Asset Management has really been focused on the sustainability and transition to a more sustainable economy, and that was a real favorite of other investors. That's valuation has been more than cut in half. Again, you get a nice dividend yield, circa 6% on that one, and the valuation is nothing like it was. Clearly, there's been trend away from ESG investing. ESG is a dirty word now. Notable that Impax doesn't use that term. It used about sustainability and transition, a sustainable global economy. And it's got some good funds as well. And it actually grew its assets under management, decent performance. So another good one, you get a dividend. You may have to wait for markets to improve, but in the meantime, you're picking up nice dividend income. Another real specialist, and these are all AIM companies, they're all on the AIM market, is called Polar Capital, and it's really focused in technology, the technology sector, and Polar Capital makes a lot of investments in its own funds as well. So you get a sort of double benefit there. If its funds do well, its own business does even better. And its dividend is 8.2%. So great dividend payers, and they're all on AIM. So I keep an eye on those, because if markets do start improving, and bear in mind that Polar Capital with its technology would have been benefiting from the NVIDIA, Microsoft, Alphabet growth. So it's in a good spot there. If you want to look on the main stock market, Lion Trust. Lion Trust has been deeply out of favor. Its dividend yield is about 9 and a bit percent. It looks cheap on many levels. So I'll keep an eye on the fund management groups. It may take a while, but you're going to be paid to wait, as we like to say.
Yeah, we briefly touch on some of these companies, don't we? But it's difficult.
Yep.
In a 30-minute podcast, we can't really dive deep into them with the real details. Is there any sort of reports, detailed analysis on Investors Champion on any of these companies you mentioned?
Yeah. All of these are covered. We covered them recently, all of their results. So you can find out more about the financial details. Clearly, investment managers aren't the most thrilling of businesses. They're managing money. They earn a fee for that. You've got to identify the different funds they manage. But there's information on all of them. Impax is still run by its founder, which is always powerful for us and good to follow. But yeah, loads of information on Investors Champion site on all these businesses.
Perfect. And moving on to a company that we've mentioned a couple of times before, but it's a company that you do like. It's a company that you hold in the fundamental asset portfolio, and that's Ramsdens.
Yeah, they are. They're in the income portfolio. And fundamental, we hold across our client portfolios, our asset management business. It's a nice business. It calls itself a diversified financial services provider and retailer. it conveniently omits any reference to pawnbroking activities, because it's actually pawn. It is, people think of it as a pawnbroker, but pawnbroking is a small part of its business. I know we've covered it before. Its results this week were really good. It's growing still, opening new stores, moving further south. Its heartland was more in the northeast a bit more, and it's growing further south as well. It's opened new stores in the Cool and in Romford, which is good news. Clearly the model is working further south. It's mostly jewellery, does well out of foreign currency as well. So people going on holiday get foreign currency. What I wanted to focus on was I think people are maybe missing it a bit. These businesses are huge beneficiaries of the rising gold prices.
Yeah.
People go in and pawn their items if they don't retrieve, or they need to sell their gold items and jewellery. And what Ramsdens does, if it likes the jewellery, if it thinks it can sell it in its shops, it'll put it in the shops to resell it. If it doesn't think it's a good sale, it literally, gets it melted down and sells it on. Clearly, if it keeps that a rising gold price, it's a huge beneficiary of rising gold prices, because it's always buying at a margin as well. It's always buying below the intrinsic value of it. So it makes a lot of money on a rising price. And it's just announced it's going to launch a dedicated gold buying site. That was good news to us, but quite frankly, no, I like this business. Management are pretty capable. Why haven't they done this beforehand?
Yeah, 10 years ago.
It doesn't exactly cost a lot, does it?
No, to set up a website.
It's got all the stores anyway. They're the costly item. I don't know why it hasn't. It's been in the gold buying site forever and a day. We spoke in an earlier podcast series here about the Costco's. You can actually buy physical gold bars at Costco's in the US. Right. It's been doing a bit of business out of those, but making apparently really nice margins on them as well. But yeah, they seem to be a bit behind the curve, old Ramsdens, given they should be a core part of their business. But I do like them. Nice business, generally well run, nice diversified activities. They really sweat all their stores. They're selling making lots of different types of revenue from their stores. Good on them.
And you also hold HT&T in the fundamental asset portfolio, which is also a pawnbroker.
They are, yeah. We've held them for a while. So we hold both pawnbrokers. They're both pretty decent businesses, and you get a nice dividend out of both of them as well.
What's your thoughts on the diversification of holding two in a similar space?
We think they're both nice businesses, and they're both very attractively valued at the moment. Ramsden's really hasn't missed a beat. It didn't demand any furlough money over the lockdowns. It battened down the hatches. We think they're very different businesses. Ramsden's is mostly about jewellery, foreign currency. Its pawnbroking pledge book is tiny relative, right, whereas H&T is more about pawnbroking and lending, and its pledge book is much, much bigger. Whereas H&T wants to grow its foreign currency business. It's already a big jeweler, but it wants to grow its foreign currency business. So they have very different attributes, which is why we're happy to hold them.
That's interesting. I was just curious when you mentioned you had them both.
It's a good question. Good question.
WHSmith, which we've mentioned previously on here as well, but you're a bit of concern around the high street side of things.
Yeah, much maligned WHSmith. People don't have many good words for it, really. I speak to it calls itself the global travel retailer now. So this is not about its high street business. It's basically running its high street shops, its legacy businesses, for cash. And it's trying to put as little money as possible into those. And as you will have witnessed if you've been into your local WHSmith recently, a lot of them are looking very tired.
Very tired.
Very tired. So it's really growing its travel. And within travel, the key growing category is hospitals. And I think it's become under fire a little bit. Somebody complained, and there was a release a few years ago, how a £1 toothpaste cost somebody about a £5 in one of these hospital shops, which is pretty poor. But it's growing clearly well in airports. It's trying to grow in North America as well. And this business, look, we wrote an article on WHSmith before the pandemic. Its capital structure was absolutely fantastic. It was buying back shares, paying out loads of dividends. Its share count had shrunk. Its return on equity was huge. Its return on capital. These are all key investment measures. This business ticked every box. It was the poster child. COVID hit, everything was shut, bang. Suddenly it had to go back to shareholders and raise a heap more money. The balance sheet's nothing like it used to be. It looks far weightier. But yeah, I just wonder if stripping the high street of cash is starting to hurt it. It also owns the Funky Pigeon online card business. But I just wonder if it's maybe reached peak, ripped the heart out of high street. I mean, they commented on what was it, £8 million of savings on the high street business last year, like in the first half, and 13 million for the full year. You wonder, this is the high street trading was only forecast to generate about 42 million for the whole year. Those sort of costs, pulling all those out of that, how are they doing it? You wonder where they're finding them all. They're getting some cheaper rents. The high street rents have dropped. See, it's a big winner on the rent side, fair enough. But I wonder where the other savings are. But have they gone too far?
Do you think that they are just focusing more on the international side of things now? Because as of February, they got 1,280 travel stores, of which 590 were in the UK, 329 were in North America, and 351 were in the rest of the world. So they've got more international stores now than UK.
They're growing fast overseas, for sure. A lot of airports they're in.
Do you think that they can just carry on growing internationally and the retail here in the UK will just slowly subside and eventually disappear?
That seems to be the sign. I think they're happy for it because of the cash flow that UK business produces, which is helping to fund all this overseas expansion. But when does it come to the point where enough is enough and basically they've got to find a buyer for the UK side who could potentially resurrect it if there is a future in the high street? They've got this new concept now of Toys R Us pop-in shops. So they've resurrected the Toys R Us brand in there. They're starting to. They're running a trial. They've run it in about 5. I think the target is to have about 25 odd by the end of the year, which will be interesting to see if they can boost the performance of their UK high street stores.
Fashion goes round in cycles, and I'm not saying Toys R Us or anything like that. It's a fashion. But how many children have, when I'm growing up, and never actually experienced going into a massive or a toy store and picking, feeling, touching what they want, instead of just buying it on an app? So I could see the uniqueness of that as a kind of a unique experience for a lot of children who have never actually experienced that. I could actually see that working.
I don't think it doesn't sound a bad scheme. It's worth trying.
It's worth trying. It's worth sampling
just to see.
They've got the space,
haven't they? I assume they can resort the space. They've got the location. They need to do better with their location. I assume they've got a lot of lines that will be very slow moving. So give it a go. See how it does. What gets me about WHSmith, it seems to address a very reluctant customer base. Effectively, you're forced to use them because there's no other option. If you're in an airport, you want to buy a bottle of water or something, where can I get it? Oh, WHSmith. Or a magazine or something. Or WHSmith. If you're on a high street, you want to buy a magazine or you need a last-minute card. All right, you've got a card factory there around, but often your last resort is WHSmith.
Yeah, usually there's many different options on the high street, but as you say, when you're in an airport, and I guess that's where a lot of their margins come from because they have that captive audience, don't they, in as you say, hospitals, airports, and now train stations as well.
By the criticism as well, we looked at the Trustpilot ratings for Ramsdens, for example, is very high. Excellence for both its foreign currency and its jewellery business, which isn't surprising. I think they do a good job. I thought I'd look what WHSmith, given the bad press this company had been subjected to over the years. Apparently, it was rated the UK's worst retailer a few years ago. So I thought it's also rated excellent by Trustpilot. So.
I guess how many people are going to go on to Trustpilot when they're either sat in an airport waiting to go on holiday, or they've just returned from holiday. They're in a very euphoric kind of state. I'm not euphoric, but they're quite excited and happy, aren't they? So perhaps ranting on Trustpilot is not high on the priority.
Go on the Trustpilot and have a look. I think they've had 90,000 reviews or something of WHSmith.
Wow.
And each one, seemingly, WHSmith has responded to. I mean, they must have somebody full-time, just a team of them. It's their Trustpilot responses. So they're keen on it.
I'm just thinking here, we're talking about Trustpilot. Have you looked at Trustpilot as a company?
We have, I have. It's quite richly valued, and it's an interesting one to look at. Maybe we'll revisit that one on another date because its reputation's building, and we keep mentioning it.
Yeah,
but it's definitely embedded in our way of life, then, isn't it? Which is pretty significant. It's circa. What is it now? It's on the main. It's listed on the main UK stock market. You can buy shares in it. It's worth 850 odd billion pounds. You can benefit from that for that growing appeal, can't you?
Sometimes, if you hear much about it, the ship may have already sailed, but still, it's worth a little mention, isn't it?
Yeah, it's often you think though that share prices run up, you think you're too late, and that's happened for many great businesses. People have thought they were too late in NVIDIA, too late on Microsoft, too late on Apple. Mega performer of the past was Monster Beverage. You think you're too, but it went on to double, treble, go up 10 times after that. So often you're not late.
I know NVIDIA, you got in around about 2021, wasn't it? When you equally there thought you'd missed the boat. And
Yeah, and it then fell off a cliff after the video gaming thing. Then suddenly it's another leg.
Yeah. And have you got another company or two that you've thought, oh, God, we've missed the boat here, actually, but you've still gone with your conviction on, oh, this is a good company. I know the share price looks a little bit rich, and then it's actually proven to go on to bigger things.
So I think Microsoft has been the most obvious one. We've held it on our portfolios for a while, and everybody thought that Microsoft was a bit tired, and then it went up. Then again, it's a business benefiting from a whole different dynamic now in AI. Who would have thought that 5 years ago? You were just looking at really a stock that was benefiting from the growth of, just over the pandemic, we had the growth of its Teams business, and we had the growth of the subscription model, Office 3, then Azure, its cloud hosting business, it was going. And now suddenly you're thinking, you're on the final rung of the ladder, so to speak, and then or near the top, and suddenly you've got it's other areas. It's just incredible. These big companies have so many potential legs to keep moving. Years back, you had Apple. Years back, you had just iPods, and you had iPhones, and you had iPads, and then you had the number of people now I see wearing Apple Watches. Staggering. How can one single brand of watch be so dominant? You didn't used to see everybody wearing Omega or like that to the same extent, did you? Now, so many people wear Apple Watches.
Yeah. Anyway, that was a little side conversation. I was just curious. So yeah, should we wrap up here? We've got 3 more companies to quickly run through. One of them, Fevertree.
Yeah, briefly, Fevertree reassured that it seems to be doing okay, although there was little financial substance in its in its update. But great, Fevertree, a rare AIM success in the US market, seems to be going great guns. Keep it going. I mean, it's now more than just about gin and tonic. It's got these other flavors. It's got cocktail mixers as well, which are developing. The rest of the world business is doing okay. Ginger beers. So yeah, Fevertree, great. Look, it'll be wonderful to see that be a huge success in the US. We've had so many failures out there, so keep on going, Fevertree. Another one, less successful, put out a bizarre sort of mixed message today, was InSpec Group. We used to hold it. We haven't been buying it in fundamental portfolios. There should be a recovery story here. It's a designer and manufacturer of eyewear, sunglasses, optical frames, lenses, low vision products, a host of eyewear. It's been a bit of a basket case since arriving on AIM. Promised a lot. It's a big business. Revenues, I don't know, $200 million, and doesn't seem to make any money from it. But maybe there's a recovery story. If they can get to grips with their manufacturing, might be a good recovery story there.
Finally, bonkers bargain, Gemfields.
Yeah, this was one of our most recent bonkers bargains opportunities with stocks that we think are really cheap, but I'll leave you to read all the details in the Investors Champion article on the website. It's a miner and supplier of coloured gemstones. So it has a jewellery business in Fabergé, but it also has rubies and emeralds. And suddenly we got an announcement today that it's got this peripheral non-core gold exploration activity, and they seem to have had decent news from that. There's potentially more gold there. There's a substantial amount of gold. They're not saying it's economically viable yet, but the signs are positive. Should they be able to prove that up, they're going to get rid of it to a partner or get a partner to invest. So there could be more upside for investors in that one. Good news. So our bonkers bargain could be even cheaper than we imagined.
Brilliant. And on that one, we'll leave it there, shall we?
Yeah, probably appropriate.
Brilliant. Thanks, Chris.
Thanks very much. Always good fun.
Well, that's it for today. Please subscribe for next week's episode, as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics, and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.